Ladies and gentlemen, boys and girls, and the cat from Connecticut, this is your 1-minute warning. In 1 minute, a very mediocre and boring webinar will begin. Brandon Ketron is here, and that's the good news. Alan Gassman will also be there. That's not good news. So you might have other alternatives to do today. Maybe wash your clothes or iron your shirts that are already ironed, or maybe look at your Form 1040 income tax return, which very few people actually do. Brandon, any comments before Alan comes on and this webinar begins?
No, nothing for me.
All right. Well, I'm going to go iron my socks now, and I hope everybody has a fantastic experience, or at least pretend to. And remember, Brandon's mother reads all the surveys, so the better the score, the better Brandon's mother will think of him. She loves him, but only conditionally. Okay. Okay. Many weeks ago, we began giving webinars on Saturday at 11. At first, it was temporary, and then it became what it is now, constant. So, welcome to this webinar. Now, to avoid confusion, this is actually a 2-hour webinar, but there are 2 separate topics. The first topic is year-end tax planning, and the second topic is 501c4 social welfare organizations. The first topic is going to be led by Brandon Ketron, and I'm going to get in his way and ask questions. And then the second topic is going to be led by Carl Mill, who is a very brilliant charitable tax lawyer. If you came in through CPA Academy and you answer at least, I think, 6 or 7 of the polling questions, then you will get CPE credit as a CPA or an enrolled agent. If you did not come in through the CPA Academy website, then you have my condolences. The only thing you will receive today is hopefully a lot of good information and some entertainment. I will be checking my emails during this presentation, agassman@gassmanpa.com, as you see there on the screen. And we welcome your questions, comments, and suggestions. If you have questions, comments, or suggestions, all you have to do is go to the nice inverted pyramid thing that's somewhere around here. I hope I can find it. Where is it? Where is it? Well, anyway, you'll find it on your screen, and then type in your question, and we will answer it. We may answer some of these questions during the presentation and some at the end. By the way, on Tuesday, November 22nd, I will be moderating Rebecca and Shepard and Peter Hakibo's discussion of the employee retention credit, and we hope that you will join us for that. Please feel free to sign up. And let's see here. On Wednesday, November 30, Brandon and I are going to talk about the clawback with Marty Shinkman for the Florida Bar. And you can go ahead and register for that and pay the Florida Bar because they need the money. And then December 6th, I'm actually going to be in New York City to talk about estate and trust law update and business entity planning from 4 to 5 p.m. on December 6th. And if you're up in New York City and you can attend this, I'll be glad to buy you a drink at the bar, the drink of your choice, before the end of that evening. So we have more things for you, but enough of the shameless self-promotion. The first thing I want to mention for year-end planning is if you have clients that got hurt by hurricanes and storms this year, make sure you tell them that they really should have their roofs looked at much more closely than the insurance adjuster looks. Because the insurance adjusters, if there's no leakage, they will tell you your roof is fine and pay you very little, and then you'll be leaking all over the place and have mold and terrible things like that. So just be careful, and we have a whole letter there. In addition, we have summarized the information for extending the deadlines on tax returns. If you have a partnership that was in Florida, then you were able to extend your deadline even though the partners were outside of Florida. So the information is there. In addition, employers can pay employees for damages, and the employer can write this off as compensation, and the employee does not have to include it as income under Internal Revenue Code Section 139. So we have a copy of Section 139 here, and one question we sometimes get is, what if I own more than 2% of an S corporation? Can the S corporation pay for my hurricane damages, which includes reasonable and necessary personal, family, living, and funeral expenses, and reasonable and necessary expenses to repair and rehabilitate my residence? The company writes that off, but do I have to include it in income because of the 2% rule under the partnership code and under the S corporation rules? And the answer is, we don't think so, because it's not mentioned as being a fringe benefit. And none of the reference texts that we've looked at have said that it would be, but it is an issue that we wanted you to be aware of. So, Brandon, I'm going to turn this over to you now and let you lead this discussion of what we can do for year-end planning. But first, I want to just plant a seed and let the listeners know, if you're a client or a colleague, that it's not only about what we can do before year end to save income taxes, but it's also about what we can do to save income taxes next year by putting proper structures in place. And by the way, are my assets protected from creditors? And by the way, is my estate plan up to date? So if you're a lawyer or a CPA and you're watching this and you're having year-end meetings with clients, I hope that it goes a little bit beyond just the income tax planning. I hope you're covering the other basics, because people really need it. So we'll plant those seeds today and let Brandon masterfully take us through these materials, which are mostly his fault.
Yeah, any mistakes are Alan's fault. The typos, I didn't proofread these, so that falls back to you, Alan.
It was the puppet did it.
Yeah, there you go. So just to start, kind of some basic kind of quick hits here that we put together, a little bit of checklist of some thoughts that you can be thinking about for high impact planning opportunities. So number one, looking at maybe shifting income that you receive to other individuals that are in lower income tax brackets is always good planning. You know, not only does that help with your rates and, you know, pushes the income to a lower rate, but then if you have other entities that are operating at a loss, you know, it's not going to offset that loss. So you might have a larger operating loss that you could carry forward, carry back to offset some prior income. So that's always a good planning idea, is to try to shift income around to lower brackets. Maybe using 678 trust that we'll get to, that would allow the beneficiary of the trust to pay the income taxes on that, which could be your children, and you can control what happens with the assets even though the beneficiary is paying the income tax. So we'll get to that. Same thing for Section 199A planning. You know, if you're over those thresholds, somewhere around 360,000, I believe, for married couples, you have specified service trade or business limitations. You have to pay a certain amount of wages in order to get the deduction. So we're going to talk a little bit about 199A planning, and the last 2 weeks we actually just went through those in more detail for Section 199A planning. So you'll see that as well if you want to go back to look at those. Charitable planning, we're going to touch base on, talking about, you know, you can't just make a $5,000 contribution to charity anymore and deduct it because of the large standard deduction that you can take. You have to get over that standard deduction. So one planning idea is you bunch your contributions in 1 year. You make contributions maybe to a donor advised fund and then dole it out over several years. You can use private foundations for this. So we'll talk a little bit about how you can maximize your charitable contributions. Unfortunately, we did lose the $300 above the line deduction for cash gifts to charities. That only applied for 2020 and 21. So you can't do that anymore in 22. Maybe you want to wait until next year. I don't think rates are going to increase since we still have a split Congress, but it's always a possibility. We're at a pretty historically low rate. They've spent a lot of money in the past 2 years responding to the coronavirus. So at some point, rates might creep up. Maybe we defer our giving if we think tax brackets are going to increase. Number 4, think about putting your children on the payroll. Make them work. It's got to be, true work to get paid. You can't just pay them for doing nothing, but that's a good way to move some income to those lower brackets and deduct some income that you would be paying a higher rate at.
And enable them to open a Roth IRA.
That is true as well. Exactly. Yep. Good planning there as well. The kiddie tax, it's back now to the rate bracket of the parents. It's no longer at the trust rate brackets. So you have some planning there that you can do. We're going to talk a little bit about how you might be able to avoid the kiddie tax by using 529 plans to help the beneficiaries support themselves, which isn't considered, we don't think, support from the parent. So that can be some good planning there. Maybe you trigger some accounts receivable this year while the income rates are lower in 22. You can pay compensation from a C corporation as well and trigger some income, and that gets it into 22 versus 23. You can consider defined benefit and cash balance plans. Alan, you want to touch base a little bit on those and how those might be helpful for year-end planning?
What I'll say is what I normally say is about 15% of the time when a small business client comes to me and I say, do you have a cash balance or defined benefit plan? And of course the client says, what's that? I say, well, why don't you get me your employee census for your 401k and let me send it to a pension actuary. Typically the actuary won't charge to do this because they would like to prepare all the plan documents, and the results can be wonderful. For example, here you have John Smith and Tom Jones and Jane and Amy and Martha all working together. Well, John makes $270,000 a year. He owns the business. The other 4 work for him. And look what you can put away for him. He's 56 years old. So at the end of the day, you can put $206,000 away for him, tax deductible, and you have to give the staff $12,000. So even in a situation where you have 2 or 3 highly paid clients and 20 or 30 non-highly paid employees, just check this out: the cash balance plan and the profit sharing plan. And then just so clients know, the IRA contribution limit and the catch up right now for 2022, 6,000 and 1,000. Next year, 6,500 and 1,000. And then your SEP plan, the compensation that can be counted on your SEP plan is going up from 305,000 to 330,000. Compensation includable for purposes of determining profit sharing and pension contributions is going up from 305,000 to 330,000. So a lot of salaries of doctors and lawyers and CPAs is going to be coincidentally going up by those amounts. So it used to be that you had to have the pension plan in place, written by and funded by with $1 by December 31st of the year that you want to take the deduction. Now you have until April of next year, but still certainly something worth looking forward to. Back to you, Brandon.
So number 8 on the list here, this might be a good time to look at that vacation home and consider whether or not you could structure it to being a rental property. And then, if the real estate market tanks, which is a possibility, with the inflated values that we're at now and maybe these higher interest rates and, the market and everything going on, you might see a little dip in the real estate market. So if you convert that to a rental property, to the extent that you lose value after that date of conversion, you can take a capital loss that's deductible. Whereas if it's still a vacation home that you're using personally, that loss is not deductible. And any loss until that date of conversion is also lost as well. It's only the value that goes down after that conversion. So maybe you convert sooner or later. There's rules that are in place related to that. You have to use it personally for a limited amount of time and actually rent the property out more than you would use it personally based on some rules that are in place. I think we have some slides on that later in the deck. I'm not sure if we'll get there, but something to keep in mind.
So Brandon, after this webinar, if you could call Marcia and let her know that we're going to convert the St. Pete house to rental and that she can only stay there 14 years in 2023, I would appreciate that.
Yeah, I'm sure that conversation is going to go well, right? But yeah, if you're looking at selling something, this might be a time to, okay, maybe I won't use it personally. Maybe I'll rent it out for a month or two and then put it on the market and see if I can get a little bit of a loss. Real estate professionals, short-term rentals are an exception to the passive loss rules, so you might be able to avoid some passive loss rules there and structure that appropriately to take some losses on real estate. Roth IRA conversions could be a possibility. You always want to look there to see what you think brackets are going to be doing in the future, and then consider a Roth conversion. Number 11, this is a great one. If you have clients that are buying boats or planes, those are eligible for bonus depreciation. They have to be structured in a right way, but if you set things up appropriately, you put it in a partnership, you write it all off, you don't use it personally for the year that you purchase it, and then you put it into a C corporation afterwards and rent from that C corporation. You can still use it personally, but you get that bonus depreciation write-off. And we have some slides on that. It is a little complicated area, but there's ways to structure that to get a big write-off on the purchase of a boat or plane. RVs, other rental vehicles could work for that as well.
So the key there, and this is the perfect time of the year to do it if there's time, is the boat or the airplane or the RV is used 100% for rental to third parties at fair market value. Even if it's only a week, it's acquired and it's used 100% for fair market value arm's length rental. And the client has to satisfy the hours test under the passive loss rules. So either they spend 500 hours finding this asset, learning about it and conditioning it, or they spend 100 hours and no one else spends 100 hours. You buy it in a pass-through entity, and then you do that for 2022. You write off the whole cost. We have a friend who had a client that wrote off a $345 million boat a few years ago. Then you convert that entity next year to C corporation, and then if the client uses it, they need to pay fair market value rent. But the depreciation deduction can be addictive to a client who does not want to pay income tax. And planes and boats have been going up in value, which is not what they used to do, but that's what they have been doing. So quite an interesting opportunity there.
Absolutely. A couple of estate planning ideas here on number 12 and 13. We've probably talked about the Biden two-step, where essentially you sell assets to a irrevocable trust outside of your estate in exchange for a promissory note. That is step one. You can keep that note in place, keep it alive and going. If it looks like the exemption is going to be reduced, maybe by legislative action, you can forgive the note. And that would be the two-step of the process. So that's something we'll talk through a little bit if we get there. We have slides on it, but it's an easy way to do an effective estate planning transaction and then have an asset which would be easily gifted and forgive by forgiveness of a note or a transfer or assignment of the note in order to use your increased exemption amount while you have it. Self-canceling installment notes, if you have a client that is subject to estate tax, they come down with a diagnosis of COVID or some other health challenge, as long as they still have a relatively chance of living for, what is it, a year, Alan, then you can enter into a self-canceling installment note. If they pass away before their life expectancy, then, or the end of the note term, you're able to eliminate that note from their estate, which is a very effective estate tax planning technique.
Now, there's a lot more to say about that and risks and whether to use a private annuity, but it should be on your checklist when a client comes in and says, I've got bad news, my husband or my spouse, whoever it is, has this type of disease, 3-year life expectancy. Don't look too happy, but you say you do have a great income tax opportunity here. And that can make the funeral a little bit less sad. Brandon, why don't we go to a polling question?
That sounds good.
We're going to go to page 51. And do you want to just briefly explain what a charitable lead annuity trust is and how that might be used before year end to get 100% tax deduction on a donation that a large part may come back to the family?
Yeah, so a charitable lead annuity trust is structured as basically an annuity to charity for a term of years. So you put in, $1 million into a trust, and you say you're going to pay charity $100,000 a year for 10 years. It's a little bit more complicated than that because there's some present value calculations, but assuming there's no growth, you pay $10,000 or $100,000 a year for 10 years. So your annuity calculation is equal to what's going in. So that's considered to all be going to charity. So it's fully tax deductible, $1 million gift to charity. It can be funded with ownership of an LLC. So you could take a discount to where the LLC might be worth 1.5 million in asset value, but for tax transfer purposes, it's only worth $1 million. So you can still say, I'm only going to give $100,000 for 10 years. You can set this up during your lifetime. You can set this up on death, make it testamentary, and is a very effective tool because the way it works is if the assets grow in value and I'm giving, $100,000 a year to charity, but I'm earning $150,000 a year. So I have $50,000 excess each year. After 10 years, that's going to be $500,000 that can then pass to a remainder trust that can benefit my family and not considered to be a gift for transfer tax purposes because it's considered to all go to charity. So there's rates published by the IRS that you have to make those calculations based upon. I think right now they're between 3 and 4%. So it's a little bit harder to beat that hurdle now to have assets remaining afterwards to benefit the family, but 3 or 4% rate of return over 20 years or 10 years, you probably will beat that and have assets remaining that can pass to the family. Now, last year, that rate was around 1%. So it made a lot of sense to do a CLAT then. A little bit tougher now, but I still think it's a good planning tool.
Yeah. So let's go ahead and go through the polling question now. And the answer, by the way, is D as in dog. I hope that your dog heard me and barked back. Okay, a CLAT can be A, fully tax deductible as if fully charitable. While you're alive, you get an income tax deduction if you do it that way. Or if you die, you get an estate and gift tax deduction. Under B, lifetime or testamentary, you can do it while you're alive or on death. C, it could be funded by part ownership of an LLC, so you might be able to use discounting in order to get more assets available to come back to the client or the children at the end of the CLAT period. Or D, the correct answer, all of the above. Okay, so thanks for that. But here's one way to do it. So the client says, I've agreed to give $1 million to my alma mater. Okay, well, why don't we put $1 million in a charitable lead annuity trust? And the charitable lead annuity trust will give $104,000 a year for 10 years to your alma mater. So you'll get $1 million deduction. And then the client says, okay, but what about what's left in the charitable lead annuity trust at the end? Oh, well, you can have that back. Wow, you mean I get $1 million income tax deduction for giving $1 million tree, and then at the end of the 10th year, there may be some extra fruit that comes back to me, even though I got 100% deduction? And the answer is yes. Now, but the client has to pay the income tax on the income for those 10 years, but that may not be much if it's all in equities. So just, again, we're planting seeds here. That's why I use the tree thing, because of the planting of the seeds. So Brandon, let's go back to where we were. Get back to where the slides once belonged. And what was next? The crest.
Yeah, Alan, you want to talk a little bit about the crest and how, we use that for insolvency planning with partnership?
Yeah, we have slides on it, but I think the main thing is, remember, we may be on the edge of a horrific recession. We don't know. People disagree. But if you have property and it's in a S corporation with a lot of debt, when the debt gets forgiven after the economy tanks, the S corporation is insolvent, so the income from discharge of indebtedness does not come through. But if you're in a partnership entity or individual ownership through a disregarded LLC, if and when this happens and the client gets a deal from the bank, then the income from discharge of indebtedness is going to be taxable unless the client is personally insolvent. So the CREST technique, if you put it in an LLC that is drafted to qualify as an S corporation, then you can make your S election 75 days after the effective date of the S election. So if the economy tanks on January 3rd, you have until March 18 to make your S election. And that's why we think a lot of clients who have their appreciated real estate that's in high debt amounts, they need to have the operating agreement and the ownership modified to qualify for S status, and then you need to be vigilant and call those clients when the recession happens. Yeah. And it's an acronym. It sounds like something. I don't know. It's not toothpaste, but I'll just brush that off, and you can take us to number 15, which is if you think you're going to have the recession, which may occur. And if you're preparing financial statements for clients, you should be saying, hey, by the way, you got a lot of debt here, and if it hits the fan, you've got a lot of assets in your name and your spouse's name. Why don't we just have you on the debt and give the assets to your spouse? And then if you can beat the bank down, the income from discharge of indebtedness will be limited to your net worth, which won't be much if you gave your assets to your spouse. So that is idea number 15. And let's go ahead and go back to more tax planning. Let's just say that there are plenty of charitable planning opportunities, such as giving appreciated assets to charitable remainder trusts so that they can be sold on a tax-deferred basis, such as if you're over 70 and a half, having your IRA checkbook handy to write a check for up to $100,000 by each taxpayer to charities. That's going to satisfy the minimum distribution requirements and also cause what's eventually going to be ordinary income to go to charity, income tax free, to take your appreciated securities, your appreciated stocks and bonds, transfer them to a donor advised fund or your own private operating foundation or your community foundation, get a tax deduction for up to 30% of your adjusted gross income to the extent that it exceeds your standard deduction for itemizing. That's going to be a great benefit. And then the client can dole the money out to the charity over a period of years. So every 2, 3, or 4 years, Marcia and I move appreciated stocks to our donor advised fund account or to our private operating foundation. And then we can give annual donations to charity. Because otherwise you could give $50,000 a year to charity, but then they'll be upset with you the next 4 years while they wait for another 50 in 5 years, or just transfer 10,000 a year to the donor advised fund and you can still get invited to all of their nice events. So that's charitable deductions in a nutshell. Brandon, do you want to cover the concept of suggesting a section 642C complex trust?
Yeah, so this goes back to, again, if you have a trust in place that has language in it that allows distributions to be made from to charities, or if you're drafting a trust, keep this flexibility in there, because there's no AGI limitation here. If the trust instrument authorizes payments to be made from income of the trust, you can get 100% charitable deduction for assets transferred to charity. So rather than the client making it and subject to AGI limitations, they have a trust that dad set up for them that allows these distributions, make it from the trust, and it offsets the trust income. So that can be a very effective plan. If the trust doesn't authorize it, then you may be able to have the trust set up a partnership. The partnership in turn makes charitable the distribution to charity, and maybe you can have it flow through that way. So that's the 642C planning. Alan talked about qualified charitable distributions.
I just want to mention this just came out that the IRS actually published a notice on November 17 as a Thanksgiving gift to charities, reminding IRA owners, if you're 70 and a half or more, you can go ahead and make this transfer. I thought it was really wonderful that the IRS came out with this. Very taxpayer friendly, very warm and fuzzy. And then make sure that you must get a written acknowledgement from the charity of your contribution and the fact that you did not get anything in exchange. So this cannot be to attend the annual gala or to attend the annual dinner. This would be a flat out deduction. So very IRS friendly. By the way, I just want to mention that there's been some recent appellate court cases which have indicated that any IRS notice that has ever been published that is legislative in nature has no force or effect, because the courts are saying that these are actually like regulations and that the IRS did not follow the Administrative Procedure Act. So stay tuned on that. We'll put something in the Thursday report the next Thursday we publish it. But that's going to relieve a lot of taxpayers of a lot of things. It came out in one of these conservation easement cases where an IRS notice really nailed somebody who did something with a conservation easement. And the Court of Appeal said, sorry, IRS, all your notices mean nothing if they made up rules. Okay, we're going to talk about private operating foundations in the second hour with Carl Mill. So that way we're going to catch up a little bit here, and we'll throw some mustard on it too. So let's go to our second polling question, and that is at page 55. So if I have an appreciated asset and I know I'm going to sell it, I can give it to a charitable remainder trust. The charitable remainder trust sells it. The charitable remainder trust is not subject to income tax. And then the charitable remainder trust pays me or someone I choose a stream of payments that will generally be worth at least 90% of the total value of the assets. At the end of the day, this will go to the charity of the family's choice, and this will defer the income tax. So the question here is, what type of charitable remainder trust can be established during life or upon death? Either a charitable remainder unit trust that pays a percentage of its value to the individuals, for life or up to 20 years, or a charitable remainder annuity trust that pays a fixed amount for up to life or 20 years? And the answer is C, both A and B. And C also stands for cat. Meow. If your dog barked, go ahead and let us know by email, and we will send you a free copy of one of our books, whichever one is selling the least that we have the most inventory of. Okay, let's go to something non-charitable, and that will be, boy, we have a lot of charitable here. Let's go back to the kitty tax. Meow.
So the kitty tax is basically if I were to give my son ownership of a business or some income producing asset and they don't support themselves, so I'm providing more than 1/2 of their support, then to the extent that income I think exceeds $2,000, then the tax rate is my highest tax rate. So if I'm at the 37% bracket, then whatever income I give to the child would also be at the 37% bracket. Ways to get around that: one, if they're not a child, then it's not the kitty tax. So that's over the age of 18 or over the age of 24 and out of college. So if they're still in college, then they're still subject to the kitty tax through age 24 as a full-time student. The other way to do it is have them support themselves. So they go get a job. They need $25,000 of support a year, and they earn $13,000 working part-time at the law office. Now they're supporting themselves. But if they only earn 10, well, that's not quite earning half of their support, so the kitty tax still applies. One question we get, relatively often, surprisingly, is, hey, they have a 529 plan that's paying for their college. Do I have to count that as support? And we don't think so. We think that's the beneficiary providing their own support, not necessarily support from the parents. There's some conflicting positions there. We have those, kind of discussed in this slide. But yeah, fund that 529 plan, which is, good planning anyway, tax deferred or tax-free vehicle if it's used for education. And so that could be a great planning idea, both for gifting and for this kitty tax planning as well. Now, to flip back one slide, another thing to keep in mind for year end are these thresholds for Section 199A. You get a 20% deduction on qualified business income that comes from flow-through entities, income from sole proprietorships, and you take that deduction. But if you're over a threshold, there's limitations that apply. So we should be looking at taxpayers' taxable income. If they're close to these thresholds, just over it, it's probably going to be worth, making a $10,000, $15,000 contribution to charity to get them below the threshold, so they don't have to, worry about losing a deduction or being subject to phase outs. So there's planning to be done here. Maybe they set up that pension plan that Alan was talking about, make a large contribution to that plan to get below these thresholds. So, do some projections, do some illustrations, figure out where clients' income levels are, and seeing what type of planning can be done to get below these. The other thing that you can do with Section 199A that we've talked about is setting up trust or giving ownership directly to children, or the best way to do it is through Section 678 trust, where the beneficiary of that trust pays the income tax that's received, but it's still held in a trust that's protected. Client could be the trustee, the client's spouse could be the trustee, and that income can flow through to that trust, be paid tax at the beneficiary's rates based upon the beneficiary's threshold. So even if it's subject to kitty tax, you can still get the 20% deduction on that income that mom or dad may not get because they're high income earners. And this can be a really effective planning tool for saving some income taxes using 678 trust or other trust arrangements to shift income to lower brackets for Section 199A planning.
Right, and even if you have the kitty tax and the child is taxed at the highest bracket, because of the 199A deduction, there can still be a significant advantage. And keep in mind, I set up an irrevocable trust for the benefit of my wife, Marcia, and our daughter and our granddaughter, and any charity. And our daughter is the trustee, but it's a 678 trust as to our granddaughter. So the profit goes into that trust. It's taxable to our granddaughter. It's going to get at least that 20% deduction. It's going to be taxed at my daughter's bracket above 13,000, but my daughter's bracket is lower than my bracket. And then it can all be spent on my wife for her health, education, maintenance, and support. So it can work very well, or it can be accumulated and will pass estate tax free, subject to a power of appointment that my wife will hold. So here's the next polling question, page 98, talking about the 199A deduction. A, it applies to income from certain active trades and businesses. That's correct. B, it applies to income that from flow-through entities. That's correct. C, it may be subject to certain limitations based on the type of business and the income of the owner. And the correct answer, of course, D, all of the above. That's D for donkey. That's my best donkey imitation. I've been called an ass, by the way. Okay. So you can use these trusts very effectively. You can go and look at the video where I explain to our granddaughter, Ava, how all this is going to work. If she behaves, and she's going to pay the tax on this trust, this 678 trust, and it may even buy her a house, and then we could sell the house as her primary residence and avoid capital gains taxes. And she thought it was a pretty good idea. All right. What do we have next? So there's lots of 199A opportunities. Now, another thing, so for clients who come to you and say, I'm going to sell this asset, I'm going to have a lot of capital gains. Well, before they sell it, you have the opportunity to put it into the charitable remainder annuity trust or the unit trust. But Brandon, what about after they sell it? They say, what can I do about this capital gains tax? Besides the fact that you say, well, you'll pay it, what else can you do?
Yeah, well, if it's real estate, you could look at, well, this would almost have to be set up before you sell it too. A 1031 exchange is an idea. You put the money into a escrow account with an independent party. You have 145 days to identify a replacement property, 180 days to actually purchase that property, and you get to defer the gain that way until you ultimately sell the replacement. The other way to do it is you can invest in opportunity zones. So these have to be structured, a certain way, but basically you get your capital gain. You invest that capital gain within 180 days into a qualified opportunity fund, which is essentially a investment in certain areas that are considered as designated for opportunity and development. And there's maps and there's plenty of websites where you can easily find out where these are. And you hold that for, I guess, 10 years, and you can actually, so the initial capital gain that you put in is deferred until 2026. So you get deferral into 2026. So now we're looking around 3 years or almost 4 years of deferral for investments into opportunity zones. And then to the extent that the asset appreciates in value afterwards, after your investment, you can hold it for 10 years and you can sell that without having to pay the capital gains tax. So a very beneficial, way to defer taxes for a couple of years and then also avoid capital gains taxes on a subsequent sell of the asset that you've invested into. So we have more slides on opportunity funds as well that go through this in more detail, but that's kind of the elevator speech on the opportunity funds.
Okay, so just to be clear, if you're selling real estate and it's investment real estate or business real estate, then you can use a 1031 exchange. If you do this in advance and arrange the 1031 deferred exchange agreement and use the funds to buy a replacement property and defer the tax, But if once the capital gain has occurred, whether it's a capital gain from the sale of stock or a long-term capital gain from the sale of real estate, if you take the capital gain amount, not the total sales amount, but the capital gains amount, and you invest in a qualified opportunity zone, then you will not pay the capital gains tax that for 2022. It will be deferred to 2026. And when you later sell the business that you purchased in the qualified opportunity zone at a capital gain, you will pay no capital gains tax as long as you only spent your capital gains amount to buy it. What you buy in the qualified opportunity zone can be part ownership or full ownership of a business. Now, if you buy a building that's going to be actively leased, that can qualify as a business. Or if you buy or set up a car wash, or you buy or set up a rental company, like one of these little mini warehouse type companies, then you'll defer your capital gain to 2026. And when you sell your profitable operation in more than 10 years, no capital gains taxes. And you can get more than 180 days deferral because you can put it into your own qualified opportunity zone LLC, and then that LLC will have time if it uses a subsidiary. So at least you could keep the door open to this deferral until the client decides what they want to do. So page 116 gives you more detail on deducting the boat or the airplane, but do not try this at home. There are a lot more rules than we're mentioning here. So when clients do this with larger money, we get a memorandum of guidance from a lawyer who specializes in this area, and that helps to penalty proof the situation. Okay, Brandon, anything else on section 179? Well, if you need a copier or you need anything like that in your office, get it put into place, buy it and get it put into place this year. And also, if you are going to buy a gas guzzler car, I always laugh at this, that the government will not subsidize my little Toyota or my little smart car, but they will subsidize my big gas guzzler, my Suburban, my Tahoe, my Escalade, my Cayenne, my G-Class Mercedes. It has to do with being at least 6,000 pounds. But then you do get a full deduction for a beautiful car, and this is good for the economy, apparently. Brandon, anything to add there? Do you want to go on electric vehicles? That's
just to make one quick note on this. So to actually get the deduction for those larger vehicles, it has to, if you do it under 179, you're limited to 27,000 for the SUVs. If you do it under section 168K as bonus depreciation, and this is the last year that you can do this because then the bonus depreciation is going to start phasing out next year. You can get a full deduction on that vehicle, even if it's an SUV. There's no limitation on 168K for vehicles over 6,000 pounds. There are limitations if you're under 6,000. So that's why it makes sense to buy the larger gas guzzler, as Alan referred to. But again, this is the last year to do it. Next year, you only get 80% written off. 24, it's down to 60%, 25, 40%, 26, 20%, and then gone thereafter. So you have a short term here to make that happen. And it's difficult to get these vehicles now. So you can't just go December 31st and buy one, because remember, it's got to be placed into service. And it might take a couple of weeks to get this vehicle in as well. 168 can also create a loss, whereas 179, you're limited to your actual income amount. So there's advantages and disadvantages under both of these sections, so make sure you're in the right one. And these slides will kind of help point out those differences. Okay, electric vehicles. This is something that was under the new, what was it, the Inflation Adjustment Act, I believe, that allowed for a tax credit if you purchase an electric vehicle, but you have to have annual income of less than $150,000. So I think this is a tough one. One, because of the way they wrote the statute, it made it hard to qualify because it had to be in a vehicle produced in the United States. And then if you're only making 150, can you really afford an $80,000, $90,000 Tesla? So that makes it tough too. But this opportunity is here. There is a $7,500 tax credit for these purchases through the 2032 tax year.
Brandon, I'm going to go back to page 68 and just run the last polling question for this hour.
All right.
That way everyone can turn down the sound until the next hour. And the polling question is, the settlor of a charitable remainder unit trust can retain which of the following rights over the trust? The answer is D as in dog. A, the right to change the charity. B, the right to appoint a new trustee. C, the right to appoint a successor trustee. And also the right to take a trustee fee. When people run the numbers on a 6% CRUT, I don't know why they don't show 6.5%, because the trustee could take a trustee fee. But the right answer is all of the above. Brittany, how do we do? A round of applause for all of you. Thank you very much. And now I'm going to go to the Fun and Dying, page 125, the federal estate tax. And we have new numbers to remember. The exemption has gone from 12 mil, or will on January 1st go from 12,060,000 to 12,920,000, and twice that for a married couple. So that'll be what, 23,850,000, and then, or 840,000. And then the annual exclusion, the amount you can gift every year, it's 16,000 now. And remember, if your client wants to set up 529 plans, they can go 16,000 times 5 and use their exemption for this year and the next 4 years. Or they can wait until January and use 17,000 times 5, which is 85,000. And one thing I often find is I'll find a client who has $3 million in his personal brokerage account and only 50,000 in the 529 plan for his 5-year-old. And I say, how much do you think you need in that 529 plan? And he goes, well, at least $250,000, because my 5-year-old's going to go to undergraduate, graduate, medical, post-medical. So I say, why don't you just fully fund the 529 plan so you can get as much growth going as possible in that 529 plan? And the client often says, well, my investment advisor said I should do it $150 a month. Well, get a new investment advisor, go ahead and fully fund that 529 plan so you get as much appreciation as possible. The other thing I want to say about planning with the 529 plan, and I've run the numbers on this, so believe me, it's true. You paid $150 for a 529 plan. Now it's worth $120. What do you do? And the answer is start a new 529 plan with $150. So all the appreciation in that $150 will be to your benefit, and the next $30,000 of appreciation in the old 529 plan is tax-free. So as long as you're working with low-cost 529 plans like the T. Rowe Price and the Vanguard and the Fidelity 529 plans, if you have had a significant reduction in the value of your 529 plan, run the numbers, you will see that it's better just to start a new one. And then the old one, when it reaches that level of what it cost you, you can decide whether to keep it or whether to cash it in.
Yeah.
So Brandon, what else?
One other important point now with the 529 plan, it's creditor protected, and you can also use it for up to $10,000 for K through 12, private school education. So
each year,
right. You don't have to wait to college anymore. You can use it to pay for, the private school that the kids go to. So it's much more valuable now than it historically has been.
Now, when you're talking to your clients who are willing to plan, make sure they understand that in 2026, their exemption may go to half. So this $12,920,000 exemption, maybe it'll be $14 million in 2025 with inflation, and then $7 million in 2026. So, and then they say, well, what I'll do is I'll donate $7 million in 2025 to use the part I'll lose. And no, you'd have to donate the whole $14 million. to get to it. So they need to think about this now. They can't wait until the last minute unless they have plenty of assets to do it with, because if you try to do it with assets that are, I'm looking for my handy dandy chart here, but it may not be here. If they, yeah, there it is. If they try to do it by owing a promissory note to their family, or by setting something up that may come back to them and be taxable in their estate, then they have to get that out of the way and fully paid off or fully fixed, either 3 years before they die or 18 months before 2026, because of those clawback rules. So start talking to the clients now, because it's already going to be 2023. 2026 is coming. You've got deadlock in the Congress, of course. You've got a Democratic president who's not going to back down easily from having the exemption go down. So we're going to have a very busy 2025 again, and clients who plan in advance are going to be better off. And let's see what's going on with the interest rates.
Yeah.
My gosh, look at these interest rates. You've got the September of 2021, when we did a lot of installment sales, we were at a 1.73% rate for that family installment sale. What are we now in November? 3.92%, and it's going up. December is over 4%. So because when you do an installment sale, you can use the lowest rate from the rate of the sale or the last 2 months, we are now closing installment sales at 3.14%. But if we can't get them closed in November, we have to go to 3.43% for a sale that we close in December. So that extra 0.3% can make a difference. And look at this, if we can't get it closed in December, if we get it closed in January, we're going to be at 3.92%. So get your clients off their behinds and get these installment sales done, keeping in mind the step transaction doctrine. If you throw assets in an LLC and then you sell the 99% non-voting member interest in the LLC in exchange for a note, the IRS is not going to let you use a discount unless you had those assets in that LLC for quite a few days. We know someone got away with putting Dell stock in an LLC for only 9 days before the transfer, but that's only according to one court. So we like to have it in there for 30 days. Mm-hmm. So we're working hard with a few clients to get these sales done by November to use that September rate. So look at these rates. Look, when I first started working with installment sales, it was in the 90s, and we were working at 6% rates, and it worked beautifully because inflation was causing everything to grow at way over 6%. But look at this beautiful opportunity we had. These rates were really nice and low. And now look at how they're edging back up. Now, it's still worthwhile to do a 4% sale based upon experience. When inflation goes up, stock market growth goes up, real estate growth goes up. It still makes sense, but get it done this month. Get it done while you can. And if you can make it a self-canceling installment note, that is very nice. Something else that is better now, when the interest rates go up, the one thing that is better is the is the qualified personal residence trust. Because when the rate is up, the discount for the fact that the descendants don't inherit under the CUPERT for a number of years causes the higher discount. And we do have a handy dandy spreadsheet that you can use. Oops, there it is. Those of you who have not gotten a copy of our Excel spreadsheet on how to show the estate tax savings on a qualified personal residence trust and the possible income tax load that may be caused. You're welcome to get this from us, and we do have webinars that have explained it. But the office says that this is Allen proof because I'm not smart enough to put numbers into columns. So now with Excel, you can build in arrows. So if you want the house to be worth more, you can make it worth more. If you want the estate tax exemption to be higher, you can make it higher. The percentage of rent when they start paying rent after the term of years. But this will show the client the Cupert savings. And I thank Brandon for all his work on this. So I think we have, Brandon, about a minute. Are there any questions that you want to answer, or will we do most of these by email?
Yeah, I saw a couple of good ones. One was related to the trust deduction under 642C. You do have to have income in order for that to work. The trust has to have actual fiduciary accounting income that would then be payable out to a charity. It can't just have, a principal at, just no growth, no income, and make a distribution to charity and get a deduction. It's got to come from some sort of income source. The other question were on the QCD. It does have to be, that's the qualified charitable distribution from your IRA. It does have to be made directly from the IRA custodian to the charity. It can't go to the client, then to the charity. That doesn't work. And it does also satisfy the RMD for, that $100,000 that you send takes care of $100,000 of RMD. There's a couple others I saw. So, Alan, on the boat depreciation, once you convert to C, there is no depreciation recapture, right? Because there's the way to get around that.
Sell it.
Converted it to a C.
Until you sell it. Now, when you finally sell the boat, you'll recapture all your depreciation. But if it's 100% business in 2022, take the depreciation and then convert to C. You have to make sure there's no debt on there that would cause depreciation recapture at the time of conversion to a C corp in January, and then you should not have the depreciation recapture. But again, you should do this very carefully, only with the advice of a tax lawyer who specializes in it, and that's not us. And get a memorandum of guidance to penalty proof your client, not only on that, but on many things. So Carl, I've been thrilled to see you watching and smiling here. Did you have anything you want to say about year-end planning or anything you heard during the first hour?
No, everything I heard was great. I mean, from a year-end planning perspective, it's the usual stuff. This is the time of year where whether it's the donors we advise or even more often the charities we advise are getting sort of flooded with last-minute requests to gifts. Just be kind to your local charity. If you are going to be giving them a last-minute gift, maybe give them a week or two, because there's a lot of people like you. So that'll be my public service announcement for my charity clients is actually, let's get moving on it. So we're not calling on December 31st.
Right. So Carl, before we get started, I want to express to the audience that the law of charitable tax donations, organizations, and things that people want to do and should do for charity is incredibly complicated. And when I went to the LLM school at Florida, there was only one course on charitable giving and tax-exempt organizations, and it was only one semester, and I wasn't even smart enough to sign up and take it because the professor was too hard. And it could be an entire LLM program. You could study it a whole year and still not get it all in. So tell us a little bit about your background, because one of the messages I really want to convey here especially to advisors, there's a lot of tax lawyers and CPAs on here, is give Carl a call and pay for his time or find someone like him because instead of spending 24 hours researching it, you might find somebody who knows the answer in an hour. But Carl, how did you stumble into this? And besides the fact that I think you probably have a photographic memory and a 160 IQ, how does one become what you've become?
I definitely don't have that kind of IQ. I'm in California, so this early in the morning, it's a sub 100 IQ, but I'll do my best today. Yeah, so I started out actually doing high net worth trust and estate work at a big firm out in San Diego, and did some work with foundations and charitable remainder trusts and charitable lead trusts, all the fun stuff, and then started working at a firm called Adler and Colvin, which is a boutique law firm for nonprofits and sometimes their donors. And I had the same experience of, I thought I knew something about 501c3s and foundations, and I realized, wow, there's actually a much bigger world than I realized. And so now I advise, very big charities and small charities, and big foundations and small foundations, and big donors and small donors, not physically, asset-wise, and the all, on all the tax rules that come in, and also the opportunity. I think like today's talk is sort of a focus on one of the both kind of a news story that's interesting, but also just there's these opportunities that are out there and rules that apply that people don't think about. But if you plan smart, there's a lot to do. So I find it super fun. I've not run out of stuff to learn about, which is really my goal and work.
Beautiful. So tell us about 501c4, because nobody knew about it or thought about it for many decades.
Yeah, 501c4s are the kind of thing that, and I'll just to 501c. Everyone knows 501c3, of course. So 501c3s are charities. When we talk about charities, we're talking about 501c3 because that's the code section that they are exempt under, and it's also the thing that entitles them to charitable contributions under 170. 501c4s are a cousin. Sometimes we call them charity light, and we'll talk about maybe why that is as we go. But they've become popular. They started becoming, they've always been around. They've always been existed as what are called social welfare organizations, which is everything that's charitable and some other stuff that's just good for society generally. So it's still got to operate like it's still a nonprofit. It still has a large, broad purpose. It's not about benefiting particular people, but it can do a bit more. And the first term where 501c4s became really popular was around the time of a Supreme Court case called Citizens United that kind of changed a lot of the rules around political contributions. And I'm not smart enough to know all those rules, but I can tell you that it made, you had there were PACs, political action committees, and then 501c4s became super PACs. Because they could do all the same stuff and do more of it and with less transparency, and they became very popular. And 501c4s are actually, they've existed for, they've become really popular and well funded for, 20 years now since that case. And, they've been instrumental, and they're all around. Every the election season we just had, paid for by the friends of blah, blah, blah. Those are usually going to be 501c4s. And so people have thought about them as political organizations, which isn't really what we're talking about today, though, kind of. One thing and then what happened in 2016, the Congress passed a rule that had sort of been informally the case, but made it formally true, that extended gift tax exemption to 501c4s. When it did this, it caused people like me and other advisors to high net worth people who have charitable intentions to realize, you can actually do more with 501c4s than just regular old political stuff. You could do everything that you do in a 501c3, you can do in a 501c4. And now this gift tax exemption has kind of unlocked a lot of people saying, well, just like people took PACs and made them super PACs, why not take my foundation and kind of make it a super foundation that does more stuff than just a regular foundation does? And, we've been talking about this. These gifts have been happening. People have been creating 501c4 entities instead of creating private foundation entities for a few years now, quietly. But there were two big splashy gifts this year to 501c4s that kind of brought to light a lot of the stuff we've already been talking about. So I think the goal today is to talk about, well, hey, these are a couple interesting news items that you probably heard about, or certainly maybe one you heard about, and good to understand just with our citizen hats on what's going on here. Two, understand that this, for people who are thinking about a private foundation, maybe you'll make the same calculus that these company founders made, and say, you know what's actually maybe better for me as a C4. And just to Alan's point, one thing among the constellations we advise is there are many of our clients that have private foundations and a C4 affiliate, or a public charity and a C4 affiliate. These are very versatile instruments, as we'll talk about. So it's just really getting to know more about 501c4s and what they do, what the downsides are, what the upsides are, what are the situations you might run into them. So I'll just kind of jump in, and as we do this, we'll also use this as a chance to kind of recap your charitable options. Because like I said, I'm sort of thinking about this as this is a new item on the menu. And this, if we pretend to think of a C4 as kind of a super foundation, how does it compare to a private foundation, a DAF, a public charity, and kind of walk through those rules. So here's my expert screenshotting work here. You can tell two news stories that came out actually just within a month of each other. I think the one on the top is the one that more people know about, which is the owner of Patagonia, the Cuisinarts. I may be pronouncing that wrong. I'm safely assume they're not on the call. And so there was a big glowing New York Times coverage about, wow, they gave away their company to fight climate change and with no tax benefits whatsoever. Parentheses, that is not correct. As we'll talk about, there are many tax benefits to what they did. But it was, praise because it's going to be this 501c4 to fight climate change, climate advocacy work, and various other aligned objectives. It came actually just a month or so after a gift that I think people need to talk about too, because both for two reasons. One, it's evidence that there's money piling up on both sides of this thing. And two, it actually highlights some of the other benefits of giving to a C4, which was this gift that Bari Said gave to a new C4 created by Leonard Leo. And we'll sort of talk about what they do a little bit too, just to understand that, regardless of sort of your political persuasion, this is an opportunity to sort of C4 is an opportunity to sort of have you or your clients pursue their political objectives and also do some of the stuff, if not all of the stuff, you got from giving to a private foundation. So let me see if I can click to the next slide. There we go. So this is a Patagonia gift. This is vastly oversimplified, and there's actually a little interesting wrinkle that if we wanted to nerd out about corporate and trust structuring, we could spend a lot of time on, but I'll try to spare you, but I can't, no promises. So fundamentally what happened is the family took the company, let's call it 100% owned company. I don't actually know. Let's call it 100% owned company. And they said, we've always run Patagonia in this way that's really progressive, right? We pay our employees a lot. We have these sort of policies and where we source from, all that kind of stuff. We want that to last forever. We don't want that to go away. So we kind of want to hold on to this thing. On the other hand, let's be honest, well, there's two things. One, we want to give a few $1 billion. We want our fortune to fight climate change. We think this is the issue of our generation, the generations to come, and that's where we want our money to be working on this thing. We don't want the value of this just making our family rich. And of course, hard to ignore the fact that if they died owning $3 billion worth of Patagonia stock, that is a $1.2 billion estate tax. So some incentive there to not die with it as well, right? And both of these things are happening at the same time. Now, if you go back 10 years, you'd be in a hard spot because, to be clear, there is no estate tax deduction for gifts to C4s. There's only an estate tax deduction for gifts to 501c3s. And 10 years ago, there wasn't a gift tax deduction for 501c4s either. And so it's like, okay, well, if you want to get this out of your estate and you don't want to pay tax on it, you can only give to a foundation. And we know when you give to a foundation, you sign up with a bunch of rules. No lobbying. Makes it hard to fight climate change if you can't lobby. No electoral activity. And it makes it hard to fight climate change if you can't give money to the candidates who support the policies you want to support. And so it's like, it may not be a perfect fit, or, you could certainly do a lot of good work in a foundation, but it wouldn't do exactly what you want it to do. Once in 2016, once you had this sort of change to the gift tax rules, but not the estate tax rules, planners started looking at, well, look, if I use this gift tax deduction, I could take this large fortune, move it to an organization that does all this stuff. It's out of my estate, and it can go and do all these political things and pursue for generations to come my political objectives. So, and just to recap one other thing, and we'll drill into the differences more in detail. 501c4 is tax exempt, doesn't pay tax on its income. That's great. But it doesn't get a charitable contribution. So this is sort of underlying everything that happened here. So what happened here? So they took the value of the company, restructured the company. So basically all the value was associated with non-voting stock. So the economic rights of the company are in the non-voting stock, and moved all that to a C4. So didn't have to give up control of the company to a C4 because it wasn't voting stock, but they did give up all the economic value of the company to a 501c4. That's a $3 billion transfer. In the old world, that would have been a $1.2 billion tax. Now it is a $0 gift tax. This C4 now has $3 billion to pursue climate advocacy, other the advantages we'll talk about later. And it pays and when it starts selling that Patagonia stock, which you can guarantee is extremely appreciated, no income tax because it's a C4. It doesn't pay tax. Doesn't even pay the 1.39% tax that private foundations pay. But remember, I said they wanted to keep control of the company, right? So they don't want the C4 to run the company. Maybe other investors or other stakeholders in the company don't want this other organization to run the company. So they created what's called a perpetual purpose trust. And this is like a very trendy in certain circles way of sort of taking companies and shifting ownership to a non-exempt vehicle. It's not exempt. But remember, they stripped most of the value out of it. They moved the value to the non-voting stock. So this is really just the right to vote and not really get much money, presumably. They transferred all of that to this trust. This trust locks in perpetuity, hence the name, that they're going to keep up with all the company's values, right? That they're going to do all the soft stuff, maybe not charitable stuff, maybe not even social welfare stuff, but stuff like make sure the employees are always well paid. Make sure we don't do business with these kind of bad companies. All that sort of stuff is locked in forever. So that perpetual trust controls the company in perpetuity. The family actually has some rights there. They're still involved. They haven't given up control of the company. So they might be the trustees of the trust. They might be the trust protector. I don't know, but they're involved somehow. That's why the voting stock is there. So they were able to give up the value of their company to a C4, not pay any tax when it's sold, not pay any gift tax when it's transferred. They transferred the voting stock to the trust. They actually did pay some gift tax there because remember that trust isn't an exempt entity at all. So they had to pay some gift, but because they stripped all the value, that gift tax was reported at about 17 million or so, 17.5 million. That's a lot less than the tax you'd pay on $3 billion. So presumably what they did is get an appraisal. Someone said, I guess the value of this voting stock with little to no economics attached to it is about 40 million or so, and so they get to they complete that. That's out of their estate. Now the whole company's out of the estate. So you can see here, this was something I took a bit of umbrage with, and I personally think it's great. All this money is there, but I took a bit of umbrage with the characterization of this as sort of no tax benefit. Well, I can look at this and see two really, really, really big tax benefits, right? There's one big tax benefit of you've taken $3 billion of value and moved it out of your estate for the low price of $17.5 million, compared with $1.2 billion. So that's okay. We got $1.2 billion of tax benefits there. I also know that the company is worth about $3 billion. I'm going to say their basis is roughly zero because they're the founders, right? So let's just call it a 40% income tax. That's another $1.2 billion of tax benefits if and when they sell that stock. And generally speaking, why wouldn't they sell the stock? There's no voting attached to it. They need to start spending money. Those ads don't pay for themselves. So, they got to start, they're going to start selling it and no income tax will be owed. So I count about $2.4 billion of tax benefits here. And of course, that this is a big news story. And so it's interesting from that perspective. But I mean, it's easy to apply to your clients, right? Your clients are thinking about, they have assets. Maybe it's not in the $3 billion range. Maybe it's in the $3 million range. But they want to see political change happen of some kind or another. We'll talk about, the income tax deduction side of it. There's no income tax deduction, but maybe they don't have a lot of taxable income, or maybe they're making other charitable gifts. I mean, the thing about people on the ultra high net worth side of things is their taxable income doesn't look like the taxable income of people who, the suckers who get paid for legal and accounting services. Those people pay tax on their income. People with large real estate empires generally have so much depreciation deductions, they don't pay tax on their income. And so what do they need an income tax deduction for? So yeah, there's none of that, but you do still get a lot of value. And so you might have clients in that position, don't need a deduction, do have political interest, or just want flexibility. We'll talk more about that as we go on. This is an option that allowed it. And we'll drill in more on this, but let's talk about the other side of it on the Bari side gift. Let's talk about, we haven't talked in detail, but I think you've gotten the gist that you should be able to answer this question correctly. 501c4 can be used for political activities, true or false? I don't know. I hope you get this one right. So, assuming everyone has checked true, based on my references to Citizens United, all the political spending. I'm over in California, so I didn't see all the same political ads, but we get about $1 billion of ad spent on different ballot measures and props to vote on each year. So they were all brought to you by 501c4s in most cases, directly or otherwise. And so yes, 501c4s absolutely can be used for political activities, though they don't have to be. And we'll talk about that more. We'll talk about that more later.
Carl, can I ask a couple questions?
Yeah, sure.
Just not to don't leave us behind here. So
yeah,
the company was worth $3 billion.
Yeah.
How was the voting stock worth $40 million? Was that just in proportion to ownership that they kept the voting stock?
So here's what happened. Here's certainly how I would have done it and how we sort of advise clients in this situation, and what I can safely assume they did. Because they control the company, they can restructure this company before they give it however they want to. So there's nothing stopping you from creating two classes of stock. Class A stock, which has 100% of the voting rights, but 0% of the economic interest. It'll never get a dividend, it'll never get a distribution. So therefore, it should have no economic value on the market. And my guess is someone appraised the value of Class A stock at 40 million. I guess it's worth something because you control this company, but it is not, you'll never get a distribution from it. So therefore it must be worth nothing or close to nothing, or relatively, only 40 million instead of 3 billion. And vice versa, you would have the non-voting, the Class B stock. They would never get to vote on who's the board. They don't get to control it, none of those things. But my guess is they would get 100% of the dividends and distributions on liquidation from this company. So that has real value, and is something someone would pay pretty much the full price. And so, I guess one way to think about it would be, if you think just as estate tax nerdery, but if you were to talk about, if this were included in the estate, just the non-voting stock, well, there'd be a discount, right, for lack of control. Well, that discount is sort of the value of the voting stock. That's the value over there, and that's why it's a smaller amount. And then the non-voting stock is just the value otherwise. That's how I assume it's done. I think that's the whole point of this perpetual purpose trust, is to take that voting stock and have a place for it and minimize the value that you have to pay gift tax on.
Okay, so my next question is, do you know for a fact that they gave away the voting stock and paid gift tax, or you're just saying when they eventually give it away, they will?
That's in the New York Times article, that they gave it away and paid about $17.5 million to this perpetual purpose trust. We don't know what the perpetual purpose trust looks like. We don't know who the trustees of it are. We don't know what the purposes that are perpetual are, because it's not a tax exempt entity. It's not public. You can have that perpetual purpose trust, right? Whatever you want it to say. And I work with a client that helps companies convert ownership to perpetual purpose trust, not for tax planning reasons as much as just on principle. Like we want our company to have these values forever. And so they've started making these structures and shifting the value to do that. So this is something that happened. We don't know exactly who controls it. I'm sure they got great estate tax advice on how it was done. I guess that while we're here, it would be a really good thing to slow down and talk about. I know we'll talk about it more later, but just to preview, you see the Holdfast Collective is the name of that 501c4. This is where you got to be really careful in terms of how you structure it, because remember, we talked about there's no gift tax. There is a gift tax deduction, but there's no estate tax deduction. And you might say, okay, well, make the gift during lifetime and you're fine. And that's the idea. Make the gift during lifetime and you're fine. But what about 2036 and 2038, which are these Internal Revenue Code sections that says, if you gave something during your lifetime, but you kept certain control over it, or the right to decide how the income is distributed, comes back in the estate. Now with a 501c3, that's fine because, okay, it came back in my estate, but I have a charitable deduction in my estate tax deduction, so who cares? Well, with a C4, it comes back in your estate, but there's no estate tax deduction for a 501c4. This is one of the rare mismatches between the gift and estate tax. And so really, really important that when you structure these things and you structure that C4, that you have no retained control. And we'll talk about this in a little more depth later, but that is part of this too. So my guess is they have control, or perhaps more control, or a different kind of control at the purpose trust, but no control whatsoever because they don't want that stuff coming back into the estate.
Okay, so let me ask you,
yeah,
is there, because I know viewers are thinking this, is there an excess business holding issue, or that rule doesn't apply to 501c4?
No, so there's, I guess that's a good point to talk about. The thing about being a 501c4 is you're not a 501c3. And if you're not a 501c3, there's no public charity, private foundation distinction. And if there's no private foundation classification, there's no private foundation rules. And so that means no self-dealing, no excess business holdings, no minimum distribution. We'll recap all that stuff later. But yeah, I mean, this whole gift wouldn't work with a private foundation because one of the excess one of the rules that applies to private foundations is they can't own more than 20% of an active trader business. Well, this is an active trader business, and they would own more than 20% of it. And remember that you aggregate it with the family's ownership, and so it won't bore you with it, but a good chance that this might have been an excess business holding, and so that's important. So that this is another reason to consider these things, and I'm guessing part of the calculus here when they decided to use the structure.
Okay, and then the next question I wanted to ask, and I apologize if you're going to cover it later, but I'm just dying to know. This works well for a C corporation, a partnership, and an S corp. It won't work for an S corp, right?
So it gets a little tricky with the other ones, but short answer is it works. It may not work as well for a couple of reasons we'll talk about as we go. And maybe even the next one might be a good example of how we can talk about that. Because the C Corps are, in general, all of those things are things that can be donated to a C4, just like they could be donated to a C3. But just like with a C4, there's what are called unrelated business income implications, and those assets can be less favorable than the C Corp. So let me see if I can, any other questions on this slide before we switch to the other side of the aisle?
No, I'm sorry if I had too many questions.
No, the questions are perfect because they preview exactly what we're going to talk about next. I'm clicking, but nothing's happening, which makes me think I might need to ask Alan. We'll click ahead one. This one, the other big C4 gift, Bari side. This is what it looks like after the gift. So this is another company that is really a lot less interesting than the Patagonia. I think it was some sort of chip manufacturing, something really boring. This guy Bari Side is just kind of not a well-known publicly, Republican donor. He said, you know what, I really like this Leonard Leo guy. Leonard Leo is associated with the Federalist Societies. Has this Marble Freedom Trust. They've done a lot of work pushing the sort of Republican agenda in different states. And he's like, I like the cut of it, what this guy has to do, and I'd sure love to give that guy a couple $2 billion to spend on the causes I agree with him on, and get back to kind of classic charitable planning. I'm about to sell this company. And it's worth about $1.6 billion. And if I sell this company, I would pay income tax on the appreciation, which is presumably almost all of it. But hey, if I donate this company certainly if I donate it to a charity, you would know that when the charity sells it, it doesn't pay tax. It's tax exempt. So that would be good. But if I gave it to a charity, they really couldn't pursue my agenda the way I want them to, because they can do a little bit of lobbying, but not unlimited amounts. They can't get involved in candidate elections. I really like that stuff. I want to do all that stuff. So he pairs up with Leonard Leo. Hey, look, I got the C4. It does all this stuff you like. Just tell you what, you donate your company to us. Don't make sure nothing's signed, nothing's binding, because if anything's binding, you're going to pay the tax on the sale. But if you give it to us and we sell the company, you don't pay any tax. And hey, we don't pay any tax either because it's gain from a C Corp. And gain from a C Corp is not taxable to a C4, just like it's not taxable to a C3. So now you have a cool $1.6 billion in your C4, and you can do all this stuff. No retained control, because remember, so let me just kind of walk through it. No gift tax on transfer at all, because it's just the whole kit and caboodle, nothing's retained, no fancy purpose trust. And it's a C4, so there's a gift tax exemption. It's not getting pulled back in as a estate because this isn't his C4. This isn't controlled by him. It's controlled by his good friend Leonard Leo. And so it doesn't get pulled back in his estate, never gets taxed on that front. So again, we have $1.6 billion. That's a 40% income tax savings, let's say, 40% estate tax savings. We're talking, I don't want to do math, but it's a bunch of money, probably about $1 billion in tax savings here. And and now there is all this money in this vehicle that is much less regulated than other entities. And we'll kind of tick through the different entities and sort of see how a C4 compares in a second. But this is just sort of an example of the heart of charitable giving is, I always tell this to people, is sort of not the charitable contribution deduction. The heart of charitable giving is avoiding gain on appreciated assets, right? That is where the real money is in charitable giving, is giving appreciated asset to a charity or now to a C4 and letting it sell it instead of you. And so what this is all highlighting, really both gifts, but particularly this one, is highlighting, hey, you can do all the get that same tax value with a gift to a C4, and C4s get to do a lot of stuff. Yeah, I have some glib annotations here that we can skate past. But we'll I think now might be a good time to just sort of go back and look. Any questions on this gift, Alan? Anything?
No, it's very good.
Yeah, and I guess just one thing, I said this at the top, but good to kind of highlight. I think in some corners, for example, I think that took from the New York Times, one of these gifts was widely celebrated, no tax value. One of these gifts was presented as sort of ominous. Whichever side of the aisle you fall on that, I think it's just good to remember this. We don't like to use the word loophole, but this gap between the gift tax and the estate tax for C4s, as a consequence, and it benefits both sides. There are billions of dollars piling up on both sides that are going to be in these C4s. And we have one entity that's key purpose is fighting climate change. We know that a key purpose of the Marble Freedom Trust is combating environmental regulation, right? So these are billions of dollars setting off against each other. So this is part of what's going on here with these gifts. It's interesting from a policy perspective as well as a tax perspective. Let's dig in on the tax side and talk about your different options, like your clients' different options when they think about giving. And Mike, there we go. Oh, you've heard me recap this verbally. This is the chart that I like, and I think really either irritates or overwhelms some people, but I'm going to keep it anyway.
Carl, if you don't mind, let's just do the polling question first.
Yeah, let's do that first.
I apologize, but I know. So let us know if you would like to be added to our Thursday report, which is printed on many Thursdays. It's free of charge and worth less than that. A, yes. B, you are already subscribed. Or C, you would rather have a spinal tap. I think the correct answer is probably C.
Yeah, it seems right. It seems right.
It seems right. All right. So sorry, Carl. Go ahead. I'm looking forward to
not at all. Not at all. And I don't want to get lost in this chart either, but I do think I'm sure the materials will be available somewhere. When you see this chart, think about the different ways that tax exempt entities are subsidized under the tax, the benefits associated with giving to them. What I'm trying to illustrate with this chart is that 501c4s give you most, but not all, of the tax benefits that 501c3s get. So, one of the benefits of a 501c3, whether it's a foundation or a charity, it's gift tax free. Well, that's now true of C4s, so we do have to keep in mind that estate tax rule I've been talking about. Avoiding tax on appreciated asset, C4s get those too. That's great. Tax exemption, not paying tax on any passive income or income sufficiently related to exempt purposes, applies to 501c4s and C3s. And I guess on that point, Alan, you mentioned S corps and partnerships. It's a good time to bring up that rule. All of these entities need to pay tax on their unrelated business income. For all of these entities, there's a few good ways unrelated business income can come up. One is that any income from an S corp whatsoever is taxable as UBIT at regular corporate rate. So if, let's say, you donated an S corp and $1 billion S corp, which is, well, great for an S corp, and then the C4 sold the S corp stock, it would pay tax because that's gain from an S corp, and it would pay a tax at a 21% rate because that's the rate that applies to corporations. If you're clever and smart, you might use a trust and find a way to make a contribution to offset some of that UBIT, but it's complicated and we're not doing that today. Same with a partnership. Selling the partnership interest isn't taxable, but the partnership interest flows through. So if the partnership is doing active trader business, not real estate rental, but maybe something like selling widgets, that's going to show up as taxable. So that could be an issue. So S corp's kind of the worst because it's always taxable. Partnerships are sometimes taxable. The other thing to keep in mind is sort of debt finance property, mortgaged real estate. There's other things to think about with mortgaged real estate that we're not talking about. Yeah, that's really the big one. And borrowing to invest to some of these highly leveraged investment funds. If you're seeing those donated, they can generate UBIT too. The one thing C4s don't get you is charitable contribution deduction, income tax deduction. But let's remember a couple things. So one is that, if you're giving $1 billion to something, it's probably going to be a private foundation, unless you find a way to make it something else, or it could be either donor advised fund, an operating foundation, or school or hospital. And so you're getting a deduction for cash, but most of your other assets and publicly traded stock, but most of your other assets are not going to get a fair market value deduction. The other point is a point I made earlier, which is that, look, income tax deductions have AGI limits. 30%, it's either 50, it's either 60, 50, 30, or 20. Let's not bother. But there are limits. You might not get to use it. And frankly, if you don't have any taxable income, you definitely don't get to use it. And you can kind of see there, a lot of the people in this tier that are giving have found different investment vehicles that, whether it's real estate investments and depreciating income, partnerships that generate significant losses, other things that will offset income. So they frankly, billionaires, ultra high net worth people don't spend a lot of time thinking about income tax deduction. And so they get to do, they are, that the fact that C4s don't take you all the way to the end of my little chart is, for some people, not a big deal. For your clients, it might be a big deal. It depends on who they are, but this is sort of the pros and cons to think about. I guess we can go to the next slide with that one. We did the polling report. So I'm going to spend most of I'll give this one the most time because I want to remind you what the main alternative for your clients are. For your clients that are charitably inclined, the main alternative is a private foundation. We know that they are subject to very strict self-dealing rules. We know that any transaction between the foundation and the disqualified person, which refers to the donor, the directors, the officers, their family members, their companies, is an act of self-dealing, and that's regardless of whether it's a good deal for the foundation. It could be a good deal and it's still self-dealing. So really easy to screw up, frankly. Complicated rules. I would say most of the tax work I do is just talking with foundations about how not to violate these rules or to fix it if they did violate it, and how to report and correct. Operational, whoops, I think we're just going to go back to that other slide there. There we go. Let's talk about how they can operate. So the left table. They need to operate exclusively for charitable, educational, religious, or scientific purposes. They can't do anything else in any significant amount. This is relatively narrow. So I have a chart somewhere else. If you think about everything that's good for the world, charity is 501c3, and what foundations can do is a subset of that. I guess creating jobs is good for the world, so that's good, but it's not a 501c3 activity. Maybe you think that getting involved in elections is good, but it's not a 501c3 activity. Maybe it could be sort of just creating a park that's nice for people to go to. That's an activity that might fit in a 501c4, but it's not usually a foundation activity, though there's ways to certainly conservation, blah, blah, blah. Anyway, it's more limiting. There's a lot of stuff you can do in a foundation, but it's not unlimited. They have a 5% minimum distribution requirement. Each year you got to give away 5% of the value. They can't hold more than 20% of an active trader business, and that includes when you count that 20%, you combine with the family. So really tough to hold family businesses in the foundation. So there's planning stuff to talk about, but we're not going to. Stricter set of investment criteria. They can't have jeopardizing investments, so you can't. Foundations are not places to make fun bets on the stock market or crypto. Certainly not on FTX. And foundations cannot do any lobbying whatsoever. Lobbying refers to trying to influence legislation by talking to legislators or in some cases the public. There's a lot of stuff you can do that's not lobbying, but important to understand there's a lot of stuff you can't do. Foundations can't grant to non-public charities unless they follow certain rules, and they cannot do any candidate activity whatsoever. When we get to a C4, you'll see that these operational rules are much broader and more flexible, and again, another benefit to the sort of structure. So a lot of people, when they think, oh, I want to give to a 501c3, but they find out about these rules in the left column that'll happen if they're a private foundation, they say, oh, that's not exactly what I want. On the right-hand column, we have we have compared with public charities, they have less friendly deduction rules, both in terms of AGI limits and in terms of whether you get a fair market value deduction versus basis. We know that they are treated equally to public charities for estate and gift tax. That's nice. We know that they pay a 1.39% net investment income tax, unlike public charities, but they don't generally pay tax otherwise. And I think that's probably good for this slide. This is like the standard option. This is the regular foundation. I think I'm going to go a little quicker through a couple of them, but maybe the next one I think we had as a private operating foundation, if I remember my slides correctly.
Yep.
Let's find out. Okay, cool. So basically the same as a private foundation, except for two things. In order to qualify, I guess you need to satisfy a direct activity requirement. That means you can't satisfy your minimum distribution through grants. You instead have to satisfy a slightly lower requirement, but through direct activity. That means actually hiring people to do stuff and put on programs and be a museum or operate a clinic or do educational things. That is how you get to sort of be a private operating foundation. It requires actually spending money. Not always a great fit to drop $1 billion in, because it's really hard to spend 4% of $1 billion every year on your operating budget. So it can be hard to sort of start with a private operating foundation. The other benefit of being a private operating foundation, if you satisfy that requirement, the benefit is you get treated like a public charity for deduction purposes. So for people giving to you, they get the same deduction they would have gotten for giving to the Red Cross or a hospital or a school. That's nice. Otherwise, you got to deal with all the same hard stuff that any other private foundation has to deal with: the self-dealing rules, the excess business holding rules, the lobbying prohibition, all that stuff. So all that stuff is still there. But that's the operating foundation. So a little better, but not, maybe still somewhat limiting. I believe the next option I probably put on here was a DAF. Am I right?
Before you leave private operating foundation, I just want to mention that it's relatively inexpensive to set up a private foundation and to run it. So I know that there are a lot of law firms and advisors who say, well, you have to donate at least $1 million and you have to budget $10,000 to $20,000 to form it. That is not correct. These are very easy to form. The documents are pretty much boilerplate. So it's not a bad idea for a family to set up their own private foundation so they can tell everyone they have one, put $100,000 in it, and have fun with their kids and grandchildren, and it may turn into something great, or it may not. I just wanted to say that. The second thing I agree.
I agree with you, Alan, and I'm going to supplement that slightly, because I agree, and I think people are sometimes too shy about setting up private foundations. And if this is what you want, as opposed to a donor advised fund, which we'll talk about in a second, I do think you shouldn't be afraid to do it. What I would just say is, when you do it, don't do it alone. Just do it with a good accountant. You have a good accountant that knows how to do nonprofit returns, and you ask questions before you do things instead of after you do things. Things will be good. I have many clients that have many foundations, big and small, and they're very happy with them. The sad clients are the ones that come to me that did it themselves, never really talked to anyone who knew anything about foundations. And I have one that's been in a couple of years self-dealing audit because they never asked anyone and just sort of, oh, we'll just buy and sell things from the foundation, it'll be fine. And not really. And so there are, I think it is absolutely great. I just would say, make sure, be friends with your accountant, or at least, make them think you're their friend.
Right.
Because
Right.
don't when you do it alone, it's a problem. If you do it with just a little bit of advice on an annual basis, you will be very happy.
Right. The second thing is I found that a lot of clients, first of all, to have a private operating foundation, hire a teacher to go to different schools and give enrichment programs. Set up a active scholarship program from your alma mater and be involved with mentoring students and follow them through school. It's not like you have to have a lot of operations, but you have to have some operations. The 4.25% is what you spend on this teacher, what you spend on these scholarships. Or if you're going to have a park, it's what you spend to build the buildings on the park, which are assets of the foundation. So, and you only have to do that. What is it? Every 3 out of 4 years, you have to make that distribution.
Yeah, you got to pass for your first. You got to pass for your first 3 years consecutively, and then starting in year 4, it's either 3 out of 4 years, or at aggregate you pass the test basically.
Right. So it's just not. Yeah. So these
it's
things,
not as hard as people make it out to be. I agree.
Right. And what's wrong with the tax law is that it's so hard to understand this until you get someone like Carl who says, here is how you do it. If you do these things, you'll be fine. But if you try to read the Internal Revenue Code and regulations and case law, it could take you a year and a half to come to this conclusion. So
I agree.
All right, I want to do one more polling question. Sorry, but it gets people credit. Okay, we're interested in knowing this. Which of the following topics would you like to see presentations on? Asset protection, charitable planning, estate tax planning, or mathematics of estate planning? Just gives us an idea of what to do next, as there are many Saturdays in the year next year. In fact, next year there are 52 Saturdays, and that is before inflation. Okay, so Carl, now about donor advised funds.
Yeah, and this admittedly has displaced a good number of small private family foundations. Like I said, I think there's different schools of thought. But this is one reason people set up a donor advised fund, is like, look, all I really want to do is make grants. I don't care about ever doing anything else. And geez, my bank or my community foundation will let me do this, so I'll donate to them. They have some of the requirements of a PF. They can also only make grants to public charities. They don't have a minimum distribution requirement, at least not yet, though supposedly the IRS or Congress will one day do something about that. There's very little transparency. There's no separate reporting. If you want to give to stuff and not tell anyone where you're giving it to, you can give to a DAF. If you give to a foundation, you'll file a 990. It'll tell you where you're sending your money. No donor control, only advice. That is true legally. In practice, they function very much toward donor control. The DAF sponsor doesn't send your money anywhere without you advising, and they'll pretty much send it wherever you advise, unless it's illegal. So very good for that sort of simple public charity grant making. Bad fit for direct activities. They can't hire anyone. They're just buckets of money within a bank affiliated charity or a community foundation. They're not good at hiring people. They're not going to pay you, for example, because one of the requirements, although there's no self-dealing rules per se, they can't do anything, make any distributions to you or distributions that provides any benefit to you. So same basic rule there, except it's even more limited, because a foundation, you could have your kid be the CEO of the foundation. You can't pay your kid at all from your DAF. You need to be sponsored by a public charity. The benefit of a DAF is that, like a private operating foundation, you get the public charity rule. So basically, if you're coming in saying, I only ever want to make grants, but the thing I'm donating is real estate, or the thing I'm donating is privately held stock, then, well, I'm not going to get a fair market value deduction unless I give to a public charity. That's a good reason to give to a DAF. I think that's good there. Let's just sort of go. I think the next chart is sort of a recap of all the ways I think that you can think of these sort of 501c4 I think next one's a 501c4, right?
Let me ask a couple questions.
Sure.
number one, I could, if I have a private operating foundation, I can get the same tax deduction if I'm donating appreciated assets.
Correct.
And if I'm donating part ownership of my company to a 501c3 that I control, I might be a little bit more comfortable than donating my company to a public public charity.
Correct. DAFs. So yeah, DAFs have excess business holding limitations too, but just that's that's true of a private foundation as well. So yeah, I mean, certainly if you want to have direct control over the company, in general, most DAFs, there are DAF sponsors that are more flexible, but most will have a policy of you give us stuff, we sell it. This is what we do. We sell it and we invest it in our brokerage accounts. So yes, I think that's a good call out, and it's sort of a matter of liquidity with a private operating foundation in particular. If you're giving your $100 million company and no cash, okay, it's going to be hard to get to that 4% spending requirement. If you're giving a smaller amount of a company and you're giving some cash, or the company kicks out cash every year, then you're going to be able to spend it. So that's sort of, those are the things I'm usually running through when I'm doing the POF versus staff discussion.
Okay. So here's my next question. So Marcia and I have a Charles Schwab donor advised fund account. Is the donor advised fund referring to our little account at Charles Schwab, or is that referring to the Charles Schwab entire donor advised fund program?
Yeah, though that is a good example. So your account, and sometimes they are called charitable checking accounts. That makes lawyers sometimes like uncomfortable because it's not legally true, but they really feel that way. Sometimes they joke that like the point of DAFs, especially commercial DAFs, like your Schwab Charitable, is they make giving feel like not giving. Like it's like we gave, but it's still there in our Schwab account, and I can look at the balance and watch it go up, and I don't have to give it up, right? So I get to still give. I can give whenever I want. When you give to your Schwab account, you are giving to an entity called Schwab Charitable Gift Fund. That might not actually be the name, but something like that. And that is a public charity. That is not Schwab the bank. And it is one of many accounts that they maintain on their books, not bank accounts, but just sort of like, ledger accounts. And it's an asset. So when Schwab Charitable files their 990 at the end of the year, the grants he made are on there somewhere in the thousands of pages of grants listed, but they're not associated with you in person. They're just treated from a legal perspective. They are grants made by Schwab Charitable, not you, not Schwab the bank, Schwab Charitable.
Okay. The second thing the other thing I want to point out is I made a big mistake. I'm 38 years into my legal practice, and I only got involved with a local community foundation a couple of years ago. And I sure wish I had done it decades before, because I find them to be extremely friendly, extremely encouraging, not in my pocket. I don't know how they get paid, to be honest, but Marcia and I have an account with them. And then when we see someone or something in the community that we feel should be a little different, they go and handle it. And they do it just beautifully. So I don't know if that's been your experience, Carl, but
I'll share the same plug, and I'm conflicted. I've represented both corporate DAF sponsors and community foundations. But I do a lot of work with community foundations, and what I usually tell people is like, look, in terms of the fee, because every DAF charges a fee. Maybe the DAF fee will be, the community foundation might charge a slightly larger fee because they actually have employees that do stuff for charities in the area, but the benefit that you get of working with a community foundation is there's actually people to call and ask, like, hey, who should I give to? Try to call Fidelity Charitable and ask who they should give to. That's not what they're a bank. That's not what they're there for. They're there to make giving feel as, like I said, make giving feel like not giving, make it feel as seamless as possible to claim all the tax benefits of giving. The community foundation is like, oh, you want to support stuff in your area? Well, set up a DAF here. You'll get the deduction now. And if you ever want to help in terms of where to send the money, who are we giving to? Where are we giving our money? Who are other donors like you in this community giving to? Who's doing good stuff around this thing you care about? They're there to answer the phone and help you. So I'm a big fan of community foundations, and even some of the legislation around DAFs that you'll see proposed, I probably will never pass. It's proposing this idea of starting to treat community foundation DAFs differently than commercial DAFs for this reason.
Yeah, I'll just tell a very short story. About a year and a half ago, I was sponsoring a low-income neighborhood marching band, dancing band, actually. They were fantastic, by the way. And my son-in-law was able to get matching money from his employer as long as it went to a public charity. So I just needed to open an account at the Pinellas Community Foundation so I could get this matching money. So I told them what I was doing, and that was the only reason I was opening the account. They found me instruments. They found me children who were more in need than what I had found. They found me another organization that gave me a grant, and they were just very warm and fuzzy. And then they found me local organizations who give grants but do not invite or people to apply. So I had to call people on the board and say, hey, you're not allowing all these other charities to apply for your grants. Why not? So then I was able to get some other charities that were needy to get some grants. So I share that because if you want to do good for society, there's some synergism in these community foundations. But go ahead.
Yeah, no, I'll second all those points, and we'll start bringing it home. And there's some really good questions on the chat I'd love to answer. I can sort of hang on a couple minutes to answer some questions because these are good ones.
Yeah, we can go over.
Oh,
yeah.
My control is working now, so excellent. There we go. We're back to it. This is reminder what we're talking about with C4s. This is the Patagonia example. This is the Bari side example. This is what they do. And I tried to highlight the stuff that's different. They get to operate exclusively, but it's for social welfare activity. So they can do everything that a 501c3 can do and some more stuff that's generally for the public good. The next highlighted thing is they can do unlimited lobbying. And that is, again, traditionally since Citizens United is what they've been used for, is how people think about them. And they can do some candidate activity. Some is even maybe 49% candidate activity. They're not allowed to primarily do candidate activity, but they can be a whatever I guess is not primary, secondary, and apparently secondary is 49%, at least under some case law. And in fact, these things are so powerful that they've actually gotten Congress to say, you know what, we like this having this really blurry about how much we can do. If what you could do is Congress actually passed a law saying, IRS, you are not allowed to ever clarify this. So the Treasury cannot issue regulations trying to make it any more clear what they can and can't do. So this is, C4s are quite powerful now, long way of saying. No charitable contribution deduction. Give to a 501c3, you get a deduction, not true of a 501c4. I will say, this is something actually our firm has set up an affiliate C4 with the idea of maybe kind of starting to do some of our education activity there, sponsor charitable projects that employees want to work on, pro bono stuff. We're just kind of like thinking about how we might use it. And from our perspective, I think that's a business deduction. I think there's a room to make a business deduction there. And so if you're a company that doesn't really, companies usually want business deductions, not charitable contributions deduction. I do believe there's more room to think about companies giving the C4s. I'll give an example, and these are not the two companies, so I don't represent either of these companies, but it's a similar situation. I work with, let's call it the Coca-Cola Foundation. Be clear, not the Coca-Cola Foundation. And they've had this sort of company has had a private foundation, and they've for many years have been doing this stuff, and they've been hearing things from me like, yeah, you can't do that. That's self-dealing. You really can't do that. That's lobbying. And then they look over at the Pepsi Foundation, again, not the Pepsi Foundation, but their competitor in the space. And their competitor in the space gets to do all this, is doing all this crazy stuff. All stuff I would tell them, you definitely can't do that. That is self-dealing. That is lobbying. That is bad. And they're like, well, why do they get to do that and we can't? Like, why does Pepsi get to do all this stuff? And when the answer is, if you look at the Pepsi Foundation's 990, it is not a C3. It is not a private foundation. It is a 501c4 that holds itself out as a foundation, gets to do all this stuff, but doesn't have to worry about lobbying, doesn't have to worry about self-dealing, can talk, can have Pepsi for sale, that wouldn't work. And so it is a way of, and why do they get to do it that way? Well, because they funded it with, this is where the analogy breaks down, IPO stock. And so at the time they donated the stock of the company to fund the entity, they didn't need a deduction. So if you don't need a deduction, why sign up for all the other rules that I recounted on the other slides? Why not just give to a C4? That's kind of the spirit of the presentation. And I think any questions on this slide, Alan, or what works for you?
No.
I think I just have a recap slide next. Just to recap, I think it's not going for me. I did have this quick, sorry. Are you able to get back to the table slide there? I just wanted to go. So so this is the spirit. If you don't need that deduction, once the money's in a C4, it can function like a super foundation. All of the good, a lot less of the bad. Well, I guess I'd say not quite all of the good because there's no deduction, but this is kind of comparing what they can do. Um, you know, all the things I just recounted. A lot easier to own a company, no minimum distribution requirement, just need to generally operate sufficiently. Transactions with insiders, have a blast. No net investment income tax. When I say transactions with insiders, have a blast, I should point out it is still a regulated entity. It is still subject to what are called the excess benefit transaction rules. So it is allowed to deal with insiders and family members, but it needs to do so on a fair market value basis, as opposed to not at all. And with that, I think, maybe I'll just leave this slide up because I think it's a useful. I don't think the next slide is all that helpful here, and it might just be kind of good to hit a couple questions if that sounds good to you. Did you see any good ones? I saw a couple.
Let's do the final polling question.
Oh yeah, let's do that. Even more importantly,
then people with a life can go do something else, but the rest of us will wait and watch you answer these questions. So the final polling question is: Carl and I and a wonderful law student named Peter Farrell, who's at Epcot today, are writing a book called The Advisor's Guide to Charitable Giving. And we're really excited about it. And we're going to put it in a 501c3 so that we can have law students work on it towards their internships. So would you like to see our draft copy? And if yes, you have to promise to give us some sort of comment, as much as you like, and then, or B, no. So give us an A or a B, or if you mark C, we'll still be your friend. Okay. So Carl, back to you for the recap, and I'm really interested in hearing you answer all these questions. And by the way, we've had great questions, and you are, as always, a fantastic audience. We really appreciate any of your comments and suggestions. We always learn a lot from what we see from the audience and the support of the audience. So send us an email if there's something we can do better, or something you'd like to see us do, or even a guest you'd like to suggest for Saturday at noon. Please just let us know.
Great.
Or maybe a picture for Carl's wall.
I'll start with Nancy's question, which isn't about C4s, but it is a good question of why does IRS check a charity list not include churches? I want my DAF or trust to give to a church. So churches and synagogues and other religious organizations that meet the definition of church don't need to apply for tax exempt status, so they often don't, which is great for them, but sometimes annoying for you. You'll have to convince your often these churches will end up applying for a 501c3 letter in order to solve this problem for you. The ones that don't, you just have to sort of persuade your bank or trust department of, well, they are 501c3s by virtue of being a church. They don't need to apply, and they'll either say yes or no, and you might have to figure out another example. And so income tax benefit would be, someone mentioned when I was talking about income tax, I was rounding to 40. I should remind you, and a lot of you are out in Florida, I'm in the great state of California, where when we talk about income taxes, we just stack up the federal and income and round it up to 40 to call it a day. So you are correct that for some of you in income tax free states, when I say 40% for income tax purposes, that might sound a little too high. I assure you it is not in our state. Would a contribution of appreciated art to a C4 work similarly for a donor? Short answer, yes. And we know with art, what you are not getting when you give art to a C4 is a charitable contribution deduction. So, with a 501c3, if it's going to be a related use asset, in other words, it's going to be hung up in a museum, showed in your private operating foundation, you can get a deduction if you get an appraisal of the artwork that needs to qualify appraisal requirements and get a deduction. So you won't get that deduction if you give art to a C4. But if you are planning on selling the art, or you are planning on just using the art for exempt purposes, you can do that in a C4 just as easily and still avoid the gain on it. So yes, that part is good. It just sort of depends. Again, this whole C3 versus C4 thing, it gets on what are you focused on? Are you focused on the contribution deduction, is that what you need? Well, you're still going to stay in C3 land. If you are about the benefits of selling it and not paying tax, then or just using it for purposes, then maybe a C4 is good. I see at least a couple more substantive questions. I am gonna briefly skip the reasonable compensation. Well, I won't skip it. I'll answer it. There's a question about what's reasonable compensation for trustees of a private foundation. Can't quite answer that because I am no expert, but I will tell you there are salary surveys, and GuideStar has all private foundation compensation. And also just generally emphasize, in general, directors of organizations are not paid. The people that are paid are officers of a foundation, the people that do day-to-day stuff. And I guess if you're a trustee, you're kind of both, and so a trustee might be paid. I just had this conversation with someone a couple of days ago. Do you give yourself an honest appraisal of how much you would pay a third party to do these services? Look at what similar foundations are paying, pull a salary survey on how much they're paying, and how much assets and how much actual activity you are spending. Make that assessment, because remember, private foundations can only pay disqualified persons if it's for personal services, trustee services or that, but only if the compensation is not excessive. If it is excessive, it's self-dealing. Bad excise taxes happen. This kind of goes back to the thing of if you do stuff without being thoughtful about it, you can add up to more trouble. What is a DAF? I guess I flew through DAF a little too quickly. Donor advised fund at community foundations and sometimes bank affiliated foundations. C4s could be a religious org. That was someone asked, could you do a C4 that does religious stuff? Like I said, it includes everything in 501c3. So of course, it can be religious things too. Anything else that you see interesting, Alan? You wanna jump in on?
No, I got an email from someone and they asked me to point out, and it's really true, that when you have one spouse who wants to give a lot to charity and the other spouse is more reluctant to give to charity, if you at the end of the year say, hey, you guys can save 37% for whatever you put in the Schwab account, and they both say, great, let's put 300,000 and we'll dole it out over time, the less generous spouse is much more likely to write big checks. Like Carl said, it doesn't feel like a charity. So that's another reason to do that the donor advised fund.
Yeah, totally agree. It's a seamless way to give. I saw some questions about Pinkert versus Schwab. I know there's been a couple DAF cases. I am not up on them. None of them have really, frankly, no cases that I've seen so far have sort of influenced our thinking on DAFs. I mean, what I always tell people is things like Schwab, Fidelity, if you're just going to make simple grants to public charities, all kind of the same. Make sure you understand how DAFs work. Make sure that you don't legally control them. You're relying on it is a kind of a leap of faith that they're going to do what you said to do, but it is their asset at the end of the day. Stuff like that. Always happy to chat about that kind of stuff if people have follow up.
Carl, what percentage of the 501c4 can be spent on political candidate campaigns?
49%.
49%?
Yeah, and at one point, at least that's sort of the most recent case ruling, and that's what most entities follow. It is there. At one point, the IRS was offering expedited processing of your C4 application if you agreed to only do 40% and to agree to certain clear rules. So sometimes more conservative organizations, conservative risk-wise, not politically, will say, okay, we'll just cap it at 40. But still a lot, and the things that fall outside that category are quite broad, because remember, you can do, that just refers to direct getting involved in the campaign, unlimited issue advocacy, unlimited legislative advocacy.
Okay. Let me go back to some of the questions that we got while Brandon and I were speaking. Can you gift an IRA to a donor advised fund? No, you've got to wait till you die. You could take money out of the IRA and give it to the donor advised fund, but you would be better off giving appreciated assets. And then another question was, if I have no income, what happens when I donate to charity? Do you want to answer that, Carl?
If you have no income and you donate to charity, that deduction will roll over for up to 5 years. So if you have income, within the next 5 years that it will allow you to use it, then that's great. Otherwise, it may go nowhere.
Right. Another question is, can you turn 1099 non-self-employment tax income into a deduction in a simplified employee plan? The answer is no. Sorry, you can't do that. And then we had, let me see, sorry, I gotta find it. We had some questions on the qualified transfers from IRAs to charity for people over age 70 and a half. Carl, do you just want to cover the pitfalls there or the common mistakes that you would see made in that area?
Yeah, just sort of in the this is sort of the IRA distribution to
Yeah.
charity.
Yeah, because
Yeah.
whether it has to be a direct transfer or whether it can come to the client and then the client transfers it, I think those are the mistakes being made.
Yeah, it needs to be direct to the charity, and I believe it can't be either a supporting organization or a donor advised fund. If I remember correctly, though, I might that those are the ones that you need to go. But yeah, it needs to be direct. I had someone, I had again, I say like 90% of the time I work on the charity side, and the charity comes to me saying, hey, we've kind of done this. We're concerned we were kind of acting as an indirect transferee, and so that was the issue. Make sure it's going directly to the place you want it to go. Make sure that the thing you're giving to doesn't look like a DAF, and it should qualify.
Okay. All right. Well, I think that answers all the questions. Again, we really appreciate it. We're 9 minutes late, and 80% of the attendees or 85% of the attendees are still with us. We're going to let you get back to your Saturday. And Carl, I just can't thank you enough for all the help you've given us in our writing and our learning and for our client matters. It's been just great. What's the next topic we're going to cover?
I believe we're doing a deeper dive on 501c4s next time. So we'll slow down a bit, unpack how 501c4s work, how you set them up, and some of these rules in a little more depth.
Beautiful. Okay, well, thanks everyone. Have a great day, and check out Carl's blog. His website has a really nice blog. It's KarlMillblog, and you'll find it. And it's very insightful. Have a great day. Thanks.
Thanks, Alan. Have a great one. Bye.